Non-recurring items and non-operating items. Analysts are generally trying to estimate future earnings. Hence, reporting standards require firms to separate income and expense items which are likely to continue from items which are not likely to continue. A classic example of an item which is not likely to continue is discontinued operation. This is essentially an operation which a company has disposed or plans to dispose. Net income from a discontinued operation is shown net of tax after net income from continuing operation. Let's say we have a company X with a certain operation that it plans to discontinue at the end of the year. Obviously, there will be a certain income or loss associated with that operation, and that income or loss will be part of the eventual net income. However, since this operation is being discontinued, the net income, and this is the income net of tax, is going to be reported after the income from the continuing operation. And this allows an analyst to easily determine what part of the income is likely to continue and what part of the income is not likely to continue in the future. Extraordinary items. These are items which are unusual and infrequent, and this is on the income statement. The concept of extraordinary items arises only in US GAAP. IFRS prohibits this classification. Unusual or infrequent items, this term is also used in US GAAP, and examples of items which are unusual or infrequent include restructuring charges, gains and losses from sale of equipment, and so on. These items are highlighted as being unusual or infrequent but are still shown as operating expenses. Non-operating items. Non-operating items are typically reported separately from operating income because they are material and or relevant to the understanding of the company's financial performance. If you recall, we showed a very simple income statement earlier where there is revenue, then we subtract various operating expenses such as sales, general and administrative expenses, depreciation expenses, and so on. But then there might be certain expenses that are not part of the general operation of a company. Those are shown as non-operating. As an analyst, we are often concerned with the operating income, and companies have an incentive to show a relatively high operating income. So where possible, companies will try to identify certain items as non-operating and then show those items after the operating income. Under IFRS, there is no definition of operating activities. This does not mean that companies do not show an operating income or that companies do not show operating expenses. It simply means that companies need to use their discretion to determine which expenses are shown as operating expenses and which expenses are shown as non-operating expenses. Interest or dividend received, for example, would be an operating item for a financial services firm. Interest expense would be an operating item for a bank, but a non-operating item for a manufacturing firm. Generally, investing and financing activities are disclosed on a net basis, and what this means is if you consider a manufacturing firm which might be paying a certain amount of interest expense and maybe receiving some interest, then the net interest amount will be disclosed as a single line and the details will be shown in the footnotes. Here is a visual depiction of what we've been talking about, and we will take the perspective of a manufacturing company which is reporting using US GAAP. The top line shows the revenue or income, and here we need to be concerned about the revenue recognition rules. We talked about various revenue recognition criteria, but I want to make sure you remember two core criteria. The first criteria is that goods or services have been delivered, and the second core criteria is that cash has been received or there is reasonable certainty that cash will be received. With operating expenses, we have these major operating expenses typically for a company: the cost of goods sold, sales, general and administrative expenses, depreciation, which is a non-cash expense but still considered a operating expense. And then in the US GAAP context, we have a category called unusual or infrequent items, which need to be shown as part of operating expenses. Here again, we need to have expense recognition rules in mind when we show particular expenses in the income statement, and we also need to have the matching principle in mind. We subtract operating expenses and come up with operating income. Then we subtract non-operating expenses. For a manufacturing firm, interest expense would be a classic non-operating expense. We subtract non-operating expenses and come up with EBT. This is earnings before tax for continuing operations. Then we subtract taxes and come up with net income from continuing operations. Earnings from discontinued operation net of taxes are then shown after net income from continuing operations, and the details related to this can be found in the footnotes. And finally, we have net earnings or net income for the overall firm. Changes in accounting policies. New standards might require companies to change accounting policies. Companies may be allowed to adopt standards either prospectively or retrospectively. Prospectively means that we need to report based on a given change moving forward. Retrospectively means that the impact of the accounting policy also needs to be shown in financial reports from the past. Changes in accounting principle require retrospective application. So if a company is reporting inventory based on last in, first out, and now is reporting based on first in, first out, this is a change in accounting principle and would require retrospective application. Similarly, if a company is using new revenue recognition rules, then that would also require retrospective application. The example in the curriculum is about a company using new revenue recognition rules. And I hope you understand why we require retrospective application over here. If you go back to the earlier reading on accounting standards, one important characteristic is that of comparability. Obviously, you want to be able to compare numbers, expense numbers or revenue numbers from one period with the earlier periods. And if we have a situation where in an earlier period we are using LIFO and now we change to FIFO, that would mean that inventory related numbers on the balance sheet and income statement cannot be compared. So we should restate financial reports from the past to use the same standard that we are using now, or to use the same accounting principle that we are using now. This would be consistent with the characteristic of comparability. Similarly, revenue recognition rules. If we want to compare revenue in our current period with revenue in earlier periods, then we need to be recognizing revenue using the same rules. Changes in accounting estimates require prospective application. So this means that we only need to worry about the current financial reports and the reports moving forward. If we change the useful life of depreciable assets, earlier we had estimated that the depreciable life is 10 years, and now we re-estimate the life to be down to 7 years. This only requires us to make changes to accounting reports, financial statements moving forward. Correction of an error for a prior period requires a restatement of the 4 major financial statements. If a company is making corrections very often, then that is a negative signal, and analysts will generally avoid investing in companies which make frequent corrections. Earnings per share, or EPS, is an important metric and must be shown on the face of the income statement. It depicts the earnings per ordinary share. Ordinary shares are subordinate to all other types of equity. You might hear the term preferred shares or preference shares get dividends before ordinary shares. Ordinary shares are also called common shares or common stock. In terms of a simple formula, we can say that EPS is equal to the income available to ordinary shareholders divided by the number of ordinary shares. What if a company has issued securities which are convertible to ordinary shares? Examples of such securities would be convertible bonds. So if a company has issued a bond with a par value of 1,000, and let's say that this bond is convertible into 50 common shares. This is called a convertible bond, or a company might issue a convertible preferred stock. Employee stock options are also options which can be exercised by employees, and then the company has to issue new shares. Notice that with these convertible securities, there is a possibility that they will be converted, which would mean that the number of common shares will go up. In other words, the denominator over here would go up, and these convertible securities also have an impact on the numerator, which we will see over the next few slides. But there is a chance that because of the increase in the denominator, the EPS is reduced or diluted. If this can happen, then we say that these securities are potentially dilutive. We say potentially dilutive because occasionally the impact of a particular convertible security might actually be anti-dilutive, which we will see later. When a company has securities which are convertible to ordinary shares, it is said to have a complex capital structure. So if any of these exist, then the company has a complex capital structure. If a company does not have convertible securities, then we say that it has a simple capital structure. Back to the formula for EPS. We will first look at a concept called basic EPS, and later we will look at diluted EPS. Basic EPS is equal to net income minus preferred dividend divided by the weighted average outstanding shares. The net income, as we have seen earlier, is the revenue minus all expenses, and this includes operating expenses, non-operating expenses such as interest. We also subtract taxes, and then we are left with net income. This is the money available to all shareholders. But the concept of EPS is the earnings available to ordinary shareholders on a per share basis. So from the net income, we need to subtract the preferred dividend to see what is available to common shareholders or ordinary shareholders. That's why in the numerator we subtract the preferred dividend. This gives us the income available to common shareholders over a given period, let's say for the year 2010. We then have to divide by the weighted average shares outstanding. We say weighted average shares outstanding because the number of shares outstanding over the year is not necessarily static. If a company has 100,000 shares outstanding at the start of the year, and then in the middle of the year, let's say on 1st July, the company issues 20,000 new shares, which would mean that for the second half of the year, the company has 120,000 shares outstanding. What should our denominator then be? The answer is we need to use the weighted average. In this case, we have 100,000 for half the year. So we say 100,000 into 0.5 or 6 over 12 plus 120,000 into 0.5 again. And when you find the weighted average of these two numbers, you will get 110,000. In my simple example, that would be the denominator. Let's say that our net income was 200,000, and let's say for simplicity that the preferred dividend was 90,000. Then our basic EPS would be 200,000 minus 90,000, which is 110,000, divided by 110,000, which is equal to 1. So the earnings per share in this example equal 1. We'll do a few examples now which will help you understand the concept. For 2010, Giggly Limited had net income of 200,000. 50,000 was the dividend paid to preferred shareholders and 25,000 was paid to common shareholders. And then we are also given the number of shares outstanding. What is the basic EPS? The first thing you need to do here is write down the formula. The formula for basic EPS is equal to net income minus preferred dividend divided by weighted average number of shares outstanding. The net income is 200,000. The preferred dividend is 50,000. So we subtract 50,000. Notice that we are not supposed to subtract the dividend for common shareholders. The reason is, in the numerator, we are simply using the total amount of money that is available to common shareholders. It is the common shareholders or the board that then essentially decides how much of this is paid as a dividend to common shareholders. That decision of how much dividend to pay to common shareholders does not impact the basic EPS. So we ignore the dividend paid to common shareholders when we do a basic EPS calculation. We need to also compute the weighted average number of shares outstanding. We had 75,000 at the start of the year, and this was the number of shares that we had for 6 months. So we multiply this by 6 over 12, and then for the second half of the year we had 15,000 shares, which means that we then had a total of 90,000. 75,000 plus the new 15,000 gives us 90,000. This was the number of shares outstanding for the second half of the year. So we multiply this also by 6 over 12. Effectively, we are computing the average, 75,000 into 0.5 plus 90,000 into 0.5. This gives us 82,500, which represents the weighted average number of shares outstanding in 2010. And then coming back to our original formula, we have 150,000 in the numerator. That's the amount of money available to common shareholders, divided by 82,500, which is about 1.8. So the basic EPS is 1.8. Let's make the question a little more complicated now. In 2011, the net income was 300,000. 50,000 was paid to preferred shareholders and 25,000 to common shareholders. And we are also given this information. Shares outstanding at the start of the year, 90,000. Then 15,000 new shares were issued. The company also repurchased shares. This is called a treasury stock operation. And there was a 2-for-1 split on December 1st, 2011. What is the basic EPS? Let me just clarify what we mean by a 2-for-1 split. This means that if a given company has issued a stock that is trading for $20, a 2-for-1 split would mean that this one stock worth 20 is now equal to two stocks. That's where the 2-for-1 comes from. Two stocks each worth 10. Economically, there is no difference. If you had one stock before worth 20, now your net worth is still the same. You only have two stocks where each stock is worth 10. The number of shares has doubled, but the value of each share is now half of what it used to be. Whenever you see a stock split, what you need to do is adjust all numbers prior to the split based on the type of split. Here we have a 2-for-1 split, which means that as you start working back, a repurchase of 30,000 based on this new split is really a repurchase of 60,000. The shares issued 15,000 really means that according to our split number, this would be 30,000 and 90,000 would be rewritten as 180,000. To figure out the weighted average number of shares outstanding, we need to do the following. Initially, the company had 180,000 shares outstanding, and these were outstanding from 1st January to 31st March, which is 3 months out of 12. So we say 180,000 for 3 months out of 12. And then 30,000 new shares, this is based on our split, were issued. And that means that we now have 210,000 shares outstanding. These were outstanding from 1st April till October 1st, which is 6 months. Therefore, we write 210,000 into 6 months out of the 12-month year. And then for the last 3 months, we actually are going to come down by 60 because 60,000 shares were repurchased. That means in the last 3 months, we have 150,000 shares. 150,000 into 3/12. Whenever you do this calculation, these numbers need to add up to 12. If you do this calculation, you should get 187,500. And then going back to our formula, the basic EPS is equal to the net income of 300,000 minus the preferred dividend of 50,000 divided by the weighted average number of shares outstanding, which is 187,500. If you do the calculation, what you should get is 1.33. We now come to the slightly more complicated concept of diluted EPS. Diluted EPS, we compute diluted EPS using the if converted method. If you recall, we talked about the concept of convertible securities such as convertible bonds, convertible preferred shares, and so on. Now, we compute diluted EPS by saying that if the convertible securities were actually converted, then what would the EPS be? If you take a convertible preferred stock, then assuming that convertible preferred stock is converted, there would be an impact on the net income available to common shareholders. So we need to compute that net income. And then in the denominator, there would be an increase in the number of common shares outstanding because of the conversion, and that also needs to be accounted for. So let's look at a few examples now where we will compute the diluted EPS. We are given the net income, which is 750,000, and we are also told that the company has 50,000 shares outstanding and convertible preferred stock 10,000 shares. Each share of preferred stock pays $1.04 dividend and is convertible into 4 shares of common stock, what is the estimated basic and diluted EPS for the company. The basic EPS should be easy. We take the net income of 750,000 and we subtract the preferred dividend, which is 4 into 40,000, so that is 4 into 10,000, so that is 40,000, divided by the number of shares outstanding, which is 50,000. Here we are making a simplistic assumption that the number of shares outstanding is 50,000 throughout the year. Our basic EPS is then 14.2. To compute the diluted EPS, we assume that the convertible preferred stock is actually converted. What then will happen to the numerator? We have a net income of 750,000, and obviously if the preferred shares are converted, then we do not need to pay any dividends to preferred shareholders, so the minus 40,000 goes away and we are simply left with 750,000, but the denominator is going to go up. The denominator is going to be 50,000, which is the original number of shares outstanding, plus the new number of common shares outstanding, which is going to be 10,000 multiplied by 4, because each preferred stock is convertible into 4 shares of common stock. So here we add 40,000. It is simply a coincidence that the dividend and the number of shares that we convert into is the same. 10,000 into 4 gives us 40,000. When you solve, you should get 8.33. So this is the diluted EPS. Notice that it is much lower than the basic EPS. So substantial dilution takes place assuming the preferred stock is converted into common stock. Consider another example now. Net income is 500,000. Capital structure is as follows. We have a weighted average number of stocks outstanding for 2011 equal to 45,000. 200 convertible bonds, each with $100 par value and 10% coupon, convertible to 20 shares. 15,000 non-convertible preferred shares, each paying a $2 dividend. We are given the tax rate. What is the basic and diluted EPS? Before looking at the answer, I want you to try and solve this. The basic EPS is straightforward. It's the net income minus preferred dividend divided by the weighted average number of shares outstanding, and that is 10.44. The diluted EPS is a little more complicated. So we need to look at the income available to common shareholders, assuming that the convertible bonds are converted. Note that the preferred shares here now are non-convertible. We start with the net income, which is 500,000, and notice if the convertible bond is converted into stock, then obviously the company does not have to pay the interest amount or the coupon amount. The coupon amount had been subtracted when we created or when we computed the net income, so that amount needs to be added back on a after-tax basis. The 2,000 is the interest expense, and you can see that 200 convertible bonds, each with par value 200, so that's 200 into 100. That is the total par value of the convertible bonds. The interest or the coupon is 10%, so you multiply that by 10% or 0.1 and you will get 2,000. Remember that interest is tax deductible. To come up with the after-tax effect, we do 2,000 into 1 minus the tax rate, which is 0.4, and this expression is shown right here. We add it back because this amount is not going to be paid anymore, so the net income would be higher. The dividend to preferred shareholders still needs to go out because those are non-convertible. The preferred shares are non-convertible. So we subtract 30,000, which is 15,000 into 2, subtract 30,000, and then divide by 45,000, which is the original number of shares outstanding. And when we have these 200 convertible bonds, each converted into 20 shares, we will have 4,000 more common shares. You do the maths and you should get a diluted EPS equal to 9.6. Here again, there is a dilution taking place. Now let's consider an example which involves employee stock options. Net income 600,000. Weighted average number of shares is now 150,000. The company had issued 10,000 employee stock options with an exercise price of 40. Over the year, the average market price for the share was 50. What is the basic and diluted EPS for Travelling Trains Limited? Before we solve this problem, I will just help you understand what we mean by an employee stock option. And this will make even more sense later in the course when you study financial derivatives. Sometimes companies issue options to their senior management, and option very simplistically says the following. The company says to management that, look, we are giving you the option to buy the company share for a certain price. That certain price is called the exercise price. That exercise price in our particular example is 40. This is an incentive for management to do really well, because if they can get the company to perform well and the stock price goes up, then the management will be well off because they can get a stock from the company for only 40 and that stock is worth 50 in the market. So this serves as an incentive for management to maximize the value of the firm. Coming now to our example. First, let's calculate the basic EPS, and by now you should be really good at this. The net income is 600,000. Here we don't have any preferred shares, so nothing to subtract. And then we divide by the number of shares outstanding, which is 150,000. The basic EPS is 4. What about the diluted EPS? Again, we start with 600,000 in the numerator. When the options are exercised, what happens is the employees come to the company and they submit their 10,000 options, and in return the company issues 10,000 new shares and gives them to the employees. So as far as the numerator is concerned, there is no difference. The numerator is still 600,000. That is still the total amount of money available to common shareholders. There will be an impact on the denominator. We start out with 150,000 shares outstanding, and then we are going to add the number of new shares. And this is a little bit interesting. The company has to issue 10,000 new shares because employees are coming in and exercising their options. But as discussed earlier, when the employees exercise their options, they have to actually pay $40 to exercise each option and get a share. So how much money does the company make? The company will make 40, which is the amount on a per share basis, times the number of shares which are issued, that is 10,000. Overall, the company will make 400,000. The assumption now is that in order to minimize dilution, the company will take this 40,000 and buy back shares from the market. So how many shares will be bought back? 40,000 is the amount of money the company has. The stock price in the market is 50. So the number of shares that will be bought back equals 400,000 divided by 50, which is equal to 8,000. Now let's look at the net effect. The company issued 10,000 shares, so that's 10,000 more shares, but then the company actually bought back 8,000 shares. So that means the net effect is 10,000 minus 8,000, which is equal to 2,000. So overall impact is that 2,000 new shares were issued. That's the net effect. So we add 2,000 over here and we compute the diluted EPS. The answer is 3.95. Here again, notice that there is dilution taking place. The basic EPS was 4 and the diluted EPS is 3.95. Some convertible securities could be anti-dilutive. Anti-dilutive securities are not included in the calculation of diluted EPS. This is because diluted EPS reflects the maximum potential dilution. Consider this example. Net income is 1.75 million, 500,000 shares outstanding, 20,000 convertible preferred shares, each paying $10 dividend and convertible to 3 shares of common stock. Compute the basic and diluted EPS. We have been through these sorts of calculations before, and when you calculate the basic EPS, you should get 3.10, and when you calculate the diluted EPS, or if you assume that the shares are actually converted, then what do you get? Assuming the convertible preferred shares are converted into common stock, then your net income available to common shareholders is 1.75 million. The number of shares outstanding would be 500,000 plus 60,000. So you get 3.125. Notice that this number is larger than the basic EPS that you calculated. When this happens, then you report diluted EPS as 3.1 and not 3.125. It would make no sense to give a diluted EPS that is larger than the basic EPS, and that goes back to our comment here that diluted EPS reflects maximum possible dilution. These securities then are actually anti-dilutive. Coming now to section 7, which is analysis of the income statement. Broadly speaking, there are two ways to analyze the income statement, and both these methods are actually related. One is to look at a common-sized income statement. The other is to look at ratios. With a common-sized income statement, every item on the income statement is taken as a percentage of sales or net sales. Here we are looking at every item as a percentage of net sales. In 2011, the company had net sales of 1 million. So 1 million as a percentage of 1 million is 100%. Cost of goods sold is 500,000. This is 50% of the net sales, and so on. The advantage of doing a common sized income statement is that you can look at every item and see that item as a percentage of sales. Then if you do a time series analysis of the company, look at how numbers are changing over time. Notice that cost of goods sold went from 50% of net sales to 58.5%. So this means that cost of goods sold is actually increasing quite a lot. Perhaps suppliers increased their cost. Looking at the percentages is much more meaningful than looking at the absolute increase in cost of goods sold, because it is quite possible that the net sales goes up by so much that cost of goods sold goes up in absolute terms, but in percentage terms it doesn't go up that much, or in percentage terms it might also go down. But looking at the common size statement gives you a clearer picture of what's happening relative to revenue. This is a time series analysis. If you look at the curriculum also shows a cross-sectional analysis where you can compare numbers for different companies over the same time period. But again, the main point to remember is that with a common sized income statement, all numbers are expressed as a percentage of sales. Some of the most important ratios that you can extract from the income statement are gross profit margin, operating profit margin, and net profit margin. Gross profit margin is equal to the gross profit divided by sales. And notice that that number is also given in the common sized income statement. Gross profit divided by sales is 50% over here. Gross profit divided by sales for 2012 is 41.5. So it looks like the gross profit is going down, which makes sense given that the cost of goods sold is going up. The operating profit margin is essentially the operating profit or EBIT divided by sales. In this particular case, the operating profit margin is 17% in 2011 and down to 7.6% in 2012. So that also is a negative trend. Net profit margin is the net income divided by net sales, and notice that that number is going down also. Comprehensive income. Here is a topic that we'll cover in this reading on the income statement, and then when you see this item in the next reading on the balance sheet, it will make more sense. Comprehensive income is equal to net income plus other comprehensive income. Net income is what you show on the income statement. It's the revenue minus expenses which are reported on the income statement. And then there are other revenue and expense items which are excluded from the net income calculation. That impact is captured in something called other comprehensive income, which is a part of equity. But at this stage, you simply need to memorize a few core points, and over the next few slides, these points will make more sense, and when you do the reading on balance sheet, it will make even more sense. There are 4 types of items that are treated as other comprehensive income. Unrealized gains losses from a certain category of investment security called AFS is treated as other comprehensive income. This means that if the value of a AFS security goes up, that is a gain, but this gain is not shown in the income statement. It is shown in the equity segment of the balance sheet as other comprehensive income. We will see this in detail in the next reading on the balance sheet. Then these other items you just need to memorize for now, and you will learn about them when you do level 2 of the CFA program. Foreign currency translation adjustments, unrealized gain losses on derivative contracts used for hedging, and certain costs of a company's defined benefit post-retirement plan. So these are items which impact OCI and not the net income. I'll give you a simplistic illustration of how other comprehensive income works. Let's say that at the start of the year, we have this balance sheet. A company has 100 invested in a AFS security and 1,000 invested in property, plant and equipment. Those are the only assets. There are no liabilities. Equity therefore is 1,100. And notice our basic equation balances. Assets equal liabilities plus equity. Liabilities are 0. Over the year, here is the very simple income statement. Revenue 300, expenses 100, so net income is 200. We assume that the entire net income is retained. In other words, no dividends are paid, and the AFS security, which started out at 100, now goes up to 120. So what does the balance sheet look like at the end of the year? Remember, I just mentioned that the increase in value of a AFS security is part of other comprehensive income. This increase of 20 is shown as other comprehensive income. So, comprehensive income for the year is equal to the net income, which is 200, that's coming from there, plus other comprehensive income, which is 20. So the comprehensive income is equal to 220. Let's look at the balance sheet. The cash is 200. This is coming from the net income. So that's right there. The AFS security has gone up to 120. So that's shown over here. Assume that the property, plant and equipment is still at 100,000, and equity has gone up to 1,320. Notice that the increase in equity is 220. So the total comprehensive income shows us how we go from the original equity number of 110,000 to the new equity number of 1,320. The net income, or even the retained net income alone, does not explain the difference between these two numbers. That difference is explained using comprehensive income, which is a combination of net income and other comprehensive income. So to consolidate this concept, let's do the example shown here. At the start of the year, the equity for this company is 2,200,000. We are told that the net income is 1.6 million and the amount paid as a dividend is 800,000. So the retained earnings for the year equal 800,000. The ending shareholder equity is 3.2 million. Now, if you recall, the item that explains the difference between 2.2 million, the starting equity, and the ending equity, 3.2 million, is the comprehensive income. And comprehensive income is made up of net income, or actually the retained earnings, and other comprehensive income. The retained earnings equal 800,000. So we have 2.2 million plus 800,000 plus this OCI is going to give us 3.2 million. So what is OCI? OCI has to be 200,000. So that is the answer to this question. OCI is 200,000. That brings us to the end of this long reading. We will cover the most important points briefly. The first thing we talked about was revenue recognition. This is extremely important, and I will summarize the two most important revenue recognition items. The first is that the product or service has to be delivered, and the second is that we need to be reasonably sure of collecting cash. We then talked about revenue recognition for long-term contracts and for installment sales. Expense recognition, the key point here is the matching principle. Non-recurring items and non-operating items. As an analyst, we need to understand what items will recur in the future, what items will not recur. This helps us make projections. We need to understand how much money is being made from the core operation of a firm versus income that is coming from non-core activities. We need to understand the basic and diluted EPS calculation. So make sure you understand all the examples that we talked about. Common sized income statements and ratio analysis. These are tools that we use to analyze the income statement. We talked about them briefly here. Later, there will be a reading on the analysis of financial statements, which will cover these items in more detail. And finally, we talked about comprehensive income, which is equal to the net income plus OCI. As always, I will encourage you to read the summary in the curriculum, review the learning objectives, go over the examples in the curriculum, do the practice problems, and these are very good but not enough. So also try to do as many practice questions as you can from other sources. That is it.